Welcome to Dr. B.R. Ambedkar Open University students. Today, as a part of Financial Markets and Institution course, we are going to learn about the exchange rate markets. What is this exchange rate market? The exchange rate. First, let's understand the concept called the exchange rate. The exchange rate is the price of one currency in terms of another. So, whenever we have multiple currencies, as we all know, every country have its own currency. Whenever we want to buy any commodity or any service from the respective country, we need to have that foreign exchange. And for that, we may need to exchange our domestic currency with the other foreign currency, which will also affect the trade relationship between the countries. And also it has a significant impact on the inflation as well as the investments and economic stability. So in that sense, the dynamics of exchange rate is very important to understand. Who are these people going to participate in this exchange rate? This exchange rate market also known as a forex market. Here the central banks and commercial banks, financial institutions, government and policy makers, corporations and speculators and investors takes part actively in this market. So now let's understand the exchange rate market as we discussed various participants in the market. So this forex market is the one of the largest world's financial market where various country currencies are traded. Currencies like even Indian rupee, dollar, euro, or like you have the yen, so many other country currencies as on when they required they do play. And as we told, this currency markets plays very important role in terms of stabilizing the economic relationships. Then what kind of exchange rate systems do we have? Like when I said that, when we are wanted to exchange the currency market, so we can say our international finance, we could see three major categories of exchange rate systems. One is fixed exchange rate system, another is floating exchange rate system. Third one is a managed float or hybrid system. What is this fixed exchange rate system? The central bank for India, Reserve Bank of India is a central bank. For America, like a Federal Reserve is the central bank. So every country will have its own a central bank for managing this currency markets. So the central banks are crucial to play or maintain this exchange rate stability. For example, China may peg to the US dollar. Now, coming to the floating exchange rate, as in central bank in a fixed exchange rate system, central banks will fix the exchange rate between the countries. In a floating exchange market, the term itself tells you very clearly that this floating exchange rate will be determined by the demand and supply in the forex market. That means some of the countries may demand one of the country's currency more. Some countries' currencies may be a demand less. Why there will be some countries' currencies highly in demand? Because the kind of goods and services those countries produces, it may be used by across the global. So the global citizens may be demanding and seeing that there is a potential to use it. Then the more managed float, like one is we said it is completely central bank, that is in a fixed exchange rate system. In a managed float, or it's just floating exchange rate, it's purely you are leaving to the market forces. Third, another important is the managed float or hybrid system, where central banks intervenes occasionally to see that exchange rate will be stabilized. As we all know, in 2025 in the February or in the last couple of months, we have seen that Indian rupee is depreciating against the dollar. We will talk in the next lesson about why it is falling of the rupee value against the dollar. But when last few months back, that is in the 24 November December time, central bank, that is the Reserve Bank of India, has sold the dollars to an international market. As we know, India is also having a very good forex reserves. In that, the dollar is also having a very good reserves in our portfolio, in our forex exchange reserves. So to put pressure on the dollar, whatever the savings we have in the form of dollars, it has sold in the currency market so that the dollar supply will increase in market wherein the rupee may appreciate. So it has made some efforts, but those efforts by selling our dollar reserves in international market has resulted only 0.5% change in our rupee value. Over a period of time, the Reserve Bank of India has taken a call that let market forces adjust the rupee value rather than intervention through the central bank by selling our forex reserves are not yielded better results. So here the managed float means though we are allowing market force to determine the true value, but at times central bank also intervenes in the currency market by selling in the currency market. Now what are the factors will affect, like what macroeconomic factors would influence this exchange rate? For instance, inflation. As we all know, the constant increase of general level of prices, which is known as inflation. If higher inflation in the domestic country, it may reduce the currency value, because when we mean to say the inflation, the currency supply is very high, so that the currency value will depreciate. That will put pressure on the domestic currency value in a depreciation. And also the interest rates. Higher interest rates attracts foreign capital, which will strengthen the foreign currency. That means the countries which keeps the higher rate of interest have scope for attracting more capital inflows. When foreign money is flowing to domestic economy, that currency will have more demanded, because many people are coming with their investments. So the Indian currency, for instance, if a lot of foreign capital flows are coming to Indian market, our Indian rupee will appreciate. So for that, the interest rates would be very plays a crucial role. Recently we have seen that USA has increased interest rates to attract a lot of capital flows, right? So that's the one strategy to attract more capital flows. So that will create, or it will affect positively those countries' currencies. Next, economic growth. A growing economy strengthens the currency, right? Whenever the economies are growing bright and positive, it will have a positive impact, because the growth indicates that you are able to produce many goods and services which are required and demanded by the global citizens. So that is a positive sign, and the global citizens would like to consume our commodities. So hence demand for Indian currency will increase. As the demand for Indian currency increases, the rupee also will appreciate. Then look at the trade and capital flows. The current account deficit. As we know, in the balance of payments accounts, we have current account and capital account. So the current account, where it records the total goods and services transactions values. Any country have the larger deficit weakens the currency. What does that mean? Current account, as I told you, our exports and imports will be recorded as part of balance of payments account in the component of current account deficit, current account. So a country where your exports are less and when we import more, so the net impact, we call it as a net deficit. So it is basically we consume more than what we produce. So that will reflect in our current account as a deficit, or we can say that we are due to those countries to make additional payments. So when we are, instead of producing more commodities and we are only consuming, then that will be a current account deficit, and that will put pressure on currency value. It will be depreciating. So as I told you, to improve that your foreign direct investments, because we know foreign direct investments and foreign institutional investments, your FFIs are, it is also known as hot money. It only comes through equity markets and it comes as a cash flow. FFIs don't bring any kind of technology, or it won't create any assets in the domestic economy. So, but if a larger component of money coming through the FDI, foreign direct investments, that will strengthen the domestic currency value. And apart from your macroeconomic factors, trade and capital flows, the political and economic stability also are very important for countries' currencies. If there is any political uncertainty, that means if the governments are not stable, for instance, if the country's prime ministers changed every year for whatever reason, the continuity of policies will be disturbed. Even if the frequently governments are changed, that also may give a wrong signal in the global economies, in a sense that the policy shift or the policy priorities may change when the different kinds of governments comes and different kind of people heads the government. So the political certainty will be strengthened positively our rupee or any other country currencies. So that's where we say the stable governments would attract, keeping other things constant, and if your government is doing better, you will be able to attract more capital flows to the economy. So the recently, as just discussed, when the Federal Reserve has hiked the interest rate, which had also impact on Indian rupee, because a lot of the investors who want to, given the global uncertainty because of geopolitical tension and COVID-19 impact is continued to play a significant role in the trade relationships. So people are looking for their safe investments, and so people are trying to park their surplus funds with the now US banking system because the US interest rates are hiked and it looks relatively positive. So these are the theoretical story of what is an exchange rate and how this forex market is playing, what factors are influences, and why it is important for a country. We got a broader idea in the exchange market. When you want to learn further the theories of exchange rates, okay, so we have majorly three types of theories which we will not delve into details, but we'll try to understand just what are those theories. One of the most important is the purchasing power parity, which is known as PPP theory. So under this theory, the exchange rate should adjust so that goods cost the same across the countries. So they says it is also known as a law of one price principle. When freely traded goods and services across the globe, so the PP theory says that the law of one price should hold across the global economy. The currencies may be different, but if the exchange rate is very stable, if it is standardized, so that the people from India also can buy at same in the US commodities, and US citizens also can buy our goods at the same prices. So based on the respective of their currency values. So even many times when we want to compare any country, the growth and development, PPP, the purchasing power parity, also stands on the top. So that it will give you real picture in terms of how cost of living is there in the respective countries and what extent people are able to, moving on that also one can help. And there is also another theory called interest rate parity. So we have across the international also, every country have their own interest rates. It varies country to country. Internationally, standard interest rates like LIBOR, that is London Interbank Offered Rate. So this has been taken as the LIBOR is a benchmark for the global interest rates. Okay. So here under this interest rate parity, the investors moves their capital to countries with higher rate of interest. Right. Simply, this theory also explains clearly that the investors would move wherever there is a higher rate of interest, so that their return on their investment would be ideal. So then is another is to the balance of payment approach, where we see the trade volume or the total capital flows, which also impacts our exchange rate. Now let's try to understand what kind of exchange rate volatility and the speculation we have seen in historically. So speculative attacks and currency crisis, for example, 1997 Asian financial crisis. I repeat, 1997 Asian financial crisis. 2008 Turkish lira crisis, which are some of the speculative attacks, because the investors had a lot of speculation about their currencies and it has brought a lot of volatility. Volatility, nothing but the fluctuations, so which will be ups and downs in the market, which has created. Whenever there is kind of a speculation or the volatility, central banks will play a crucial role to see that the central banks will intervene by selling or buying different kinds of currencies to see that it maintains stability, its value. Post COVID-19 exchange rate trends, if you observe in India, US dollar is strengthening due to this global uncertainty. Okay, because as we all know, USA dollar has considered as a global reserve currency, because soon after the Second World War, USA had an agreement with the Saudi Arabia to see that for every oil they sell it, they will be accepting only in the petrodollars. So it has brought the idea of petrodollars. So across the globe, whoever wants to buy from this crude oil from the OPEC nations has to make payments in the form of petrodollars. So that has also brought the dollar dominancy or the dollar's stability in the global market. We will talk about in the next little lesson in the detail about those petrodollars market and euro dollar market. So as emerging countries have a lot of challenges and aspirations during their transition economy from emerging to developed country, there could be a currency volatility because the speculation and forecast makes also very bigger impact. And apart from that, recently we have seen that every central bank would like to bring the central bank digital currencies, that is CBDCs. So the CBDCs are increased in the recent past significant along with the standard regular currencies. And in addition to the central bank digital currencies, today we are encountering the growth, tremendous growth of cryptocurrency market. The cryptocurrencies are nothing but a virtual currency which is basically developed based on the technological innovations, that is a blockchain technology. So year on year, the cryptos are growing at a larger extent, particularly Bitcoin, Ethereum. Some of those currencies are playing very crucial role in international currency markets because these country currencies, they doesn't have any physical location. Across the globe, this once you earn the Bitcoin, you can buy same across the country, across the globe, any product you wish directly by using your crypto, where the exchange rate become very minimal. Though people are trying to buy exchange with the fiat currency with the cryptocurrencies, there your exchange rate may make a difference. But once the people owns the cryptos, you don't need to worry about the exchange rate because across the globe, the cryptos, particularly like Bitcoin and Ethereum, is the same. And interestingly, recently, just few days back, that is in the March first week in 2025, the President Trump has made a significant, very statement that in their recognized currency portfolios, the top cryptocurrencies will be also considered officially. That also has boosted to increase substantially the currency market in the recent past. So by looking at the emergence and the growth of the cryptocurrencies internationally, to understand the dynamics of the exchange rate market becoming very, very complex, and it is tough because unlike your fiat currencies like any other, your dollar or euro or your pound has control by the central government or the central banks, not the governments, with the central banks, as on whenever to intervene in the market to adjust the supply and demand forces in international market. But With the development of the cryptocurrencies, the monetary policy become completely ineffective as it is not owned by any country or any agency or any central bank. It's purely drives through the technology. So in the coming days, students of economics needs to understand not only the exchange rate dynamics, that how each country's value is determined in the global market with respect to the other country currencies. We also need to understand this new cryptos which are playing crucial role in global markets. So now trying to understand in a briefly that these exchange rates by and large influenced by the economic fundamentals like your growth rates, your inflation rates, capital flows, right? So all these macroeconomic factors will have a significant impact on the exchange rate. In addition to that, the government policies also will have significant impact. What kind of government policies? Like for instance, recently Reserve Bank of India started accumulating or collecting gold from international market. So it is seeing that it has to keep higher reserves for keeping in the future demand requirement. So the gold demand has increased. The other one, as I told you, when rupee was depreciating against the dollar, central bank took a stand to sell certain reserves of dollars in international market. So that policy, that initiative also has impacted our exchange rate market. After a while, it has recognized that the very precious forex reserves are sold in international market just to appreciate our rupee value, and the global uncertainty is playing a very crucial role to put pressure on the dollar. So it is decided to not to sell further our forex reserves in international market. So hence such all policies will definitely have an impact on this. So apart from this macroeconomic fundamentals, and as I discussed a few of the government policies, the market speculation also plays a very crucial role. Today the cryptocurrencies are purely dominated through the speculation of the future, the value of those currencies. Because the major limitation with the cryptocurrency is that as of now, no hackers could hack it, since it's a technology driven currency and it is not backed by any other country currency. So in the coming future, the relevance of the monetary policy is a big stake that may disrupt entire our public policy or particularly in a monetary policy. So hence one has to clear and to understand the market dynamics, particularly forex markets, is a very important. When you understand the dynamics of various currencies, how it plays a role, then it helps to the business as well as investors to manage the risk. So every company, every government has to maintain a very good size of forex reserves so that it saves their country as well as the company. Thank you.